In the past 7 days, 6 different things happened in markets, and every single one of them should terrify you. Not because the world is ending, but because most investors have no idea what any of them actually mean. The signals are just getting lost in the noise, and panic is replacing analysis. Think about it. Amazon is replacing its own employees with AI. ARM just declared war on Intel. Musk wants to build a chip factory bigger than anything ever constructed. Google may have just slashed memory demand by 6 times. OpenAI killed its most viral product, and a leaked bill in Washington just threatened to gut the entire stablecoin market overnight. But here's the thing. 5 of these 6 events are exactly what they look like, genuine structural shifts that will absolutely change how you need to think about your portfolio. But one of them, the one the market reacted to most violently, that one is almost certainly wrong. And if you sold because of it, you may have just made the most expensive mistake of the year. By the end of this, you will know exactly which of these is real, which one is noise, and most importantly, what you should actually be doing with your money right now. All right, let's dig in.
But before we get to the news, before we dive into any of those 6 events, I need to ask you to do something a little uncomfortable. Think of it as a necessary interruption. I want you to look at your portfolio right now, every single position you own, and ask yourself with brutal honesty, which of these did I buy because I genuinely understood the business, its edge, its intrinsic value? And which did I buy, well, because everyone else was buying it, the price was rocketing up, and I just didn't want to miss out? You have to be honest with yourself here. It's the most important question you can ask when the market is this twisted.
Because here's the thing, there's a very dangerous person in the market right now, and it's the disguised speculator. This is the person who bought for short-term momentum, got caught when the price fell, and is now trying to tell themselves and everyone else that they're actually a long-term value investor. You'll hear them talking about cost averaging. But listen, buying more of a bad idea on the way down isn't courage, it's just a refusal to admit you are wrong. It's slow-motion self-destruction. And in a market that is undergoing the kind of deep, structural shifts we're about to talk about, it's a fatal mistake. So, with that in mind, let's look at the first tectonic plate that just shifted under our feet. Just when software stocks were starting to look like they could breathe again, Amazon dropped an absolute bombshell. And it sent this shockwave of fear through the entire sector, raising a very real existential question about the future of software as we've known it for decades. So what did they do? Amazon revealed it is deploying a new AI agent inside its cloud division, AWS. And we're not talking about some simple chatbot here. This is a sophisticated system that automates huge chunks of its sales and technical support. It basically consolidates the deep expertise of specialists, in things like network architecture, cybersecurity, cloud computing, into a single system. So now a frontline sales rep can answer insanely complex technical questions in an instant without ever having to escalate to a human expert. And it is absolutely not a coincidence that Amazon just carried out large-scale layoffs in those exact departments. They're not just testing this thing, they are using it.
But here's the crucial part of the strategy. Amazon isn't trying to sell you this specific agent. No, they're selling the factory that builds the agents. They just launched an entire AI agents and tools section on the AWS marketplace. They're basically screaming at every single one of their customers to come and build their own custom agents on top of their platform, Amazon Bedrock. Their goal is to become the foundational infrastructure layer for this new agentic era, just like NVIDIA did for the hardware layer with GPUs.
And this just perfectly illustrates the structural shift that has software investors so completely terrified. For decades, companies bought software to make their human employees more productive, right? The entire per-seat SaaS model is built on that simple idea. But in the future, company might not buy 1,000 seats of some software package. They might just hire a dozen AI agents built on AWS that don't need a polished user interface or a monthly subscription. The software becomes the invisible plumbing, not the shiny faucet people interact with. This is why you see the software ETF down over 20% this year. The market is pricing in a potential collapse of the entire business model. The disruption is very, very real. Okay, so that massive shift in software creates an equal and opposite shift in the physical layer, the hardware. If AI agents are the future, what kind of silicon do they actually run on? Well, this week brought 2 massive developments that signal a new world order is forming in semiconductors.
For the past few years, it has been all about the GPU. The GPU is the muscle of AI. It handles the brute force parallel math needed to train these giant models. But an AI agent is different. If the GPU is the muscle, the CPU is the cerebral cortex. It's responsible for logic, for orchestration, for decision-making, and for running thousands of autonomous tasks all at the same time. Think about it. When an agent plans a trip for you, it's not doing one giant math problem. It's checking flight prices, booking hotels, reading reviews, and checking the weather, all in parallel. That's CPU work. And that is why the humble CPU is suddenly having a massive renaissance.
And right on cue, ARM just declared war. For decades, ARM was basically the Switzerland of the semiconductor world, totally neutral. They designed chip architectures, but they never made the chips themselves. Well, they just tore up that entire rulebook. They announced the ARM AGI CPU, their first ever chip designed, manufactured, and sold directly by them. It's a 136-core monster built on TSMC's cutting-edge 3-nanometer process, and it is purpose-built for these AI agent workloads. And their claim of being twice as energy efficient? That's a direct shot across the bow at Intel and AMD, because in the world of giant AI data centers, power consumption is everything.
Now, let's be crystal clear. This does not mean the x86 architecture from Intel and AMD is dead. Not at all. What it means is that their comfortable duopoly is over. We are entering the warring states era of the data center. The demand for compute to run AI agents is so massive, there's absolutely room for multiple players. But now, the big cloud giants like Amazon and Google have real options. They can play Intel's chips, AMD's chips, ARM's new chip, and their own custom ARM-based silicon against each other to get the absolute best price and performance. The game has changed. From now on, competition is going to be based on raw excellence, not just locking customers into your ecosystem.
And if ARM entering the fight wasn't enough, Elon Musk decided to just completely reset our entire definition of scale. He announced plans for a new semiconductor factory, the Terrify, with a target of producing 1 terawatt of AI compute. Now, to put that number into perspective, that is roughly 50 times, 50, the entire current global output of AI compute. It is an almost incomprehensibly ambitious goal.
So how in the world do you invest in something that audacious? Well, here's the thing. You don't have to bet on whether Musk succeeds or fails. You just bet on the process. His stated goal is to build AI data centers in orbit, powered by the sun. Now, in space, every single watt of power and every gram of mass is absolutely critical. That means he needs the maximum possible compute efficiency, which demands cutting-edge 2-nanometer chips from day one. And that leads us to the certainty play. Before a single chip can be made, before we know if the project is even viable, billions and billions of dollars in capital must flow to one very specific group of companies. And this is that group. These companies are the indispensable toll booths on the only road to 2-nanometer chips. To make those chips, you absolutely need extreme ultraviolet lithography machines. ASML has a global monopoly on them, and each machine costs $300 to $400 million. You need KLA for process control to make sure nothing goes wrong. You need applied materials for deposition, that's literally layering microscopic circuits atom by atom. And you need Lam Research for etching, which is carving those circuits with plasma. The execution risk, that belongs entirely to Musk. The revenue certainty, that belongs to these 4 companies. They get paid first.
Okay, let's dive into the central mystery. This is the one event that triggered the most violent reaction in the market. And in my view, it's the one the market is getting almost completely wrong. Google published a research paper, and almost immediately, memory stocks, companies that make HBM and DRAM, just collapsed. We're going to break down why that happened and why it is a classic textbook case of first-level thinking. This is the number that caused all the panic. Google's new algorithm, which is called TurboQuant, can reduce the memory footprint of large language models by a factor of 6. 6 times less memory needed. Now, when the market saw that headline, the logic seemed simple and brutal. If AI needs 6 times less memory, then the demand for memory chips is going to collapse. The selling was immediate, it was vicious, and on the surface, it was a totally rational fear. But here's the crucial question we have to ask. What kind of rationality are we talking about? See, there's the rationality of a short-term trader. Their survival rule is basically shoot first, ask questions later. If there's even a chance that demand will fall, you sell now and you figure it out tomorrow. That's a valid strategy for them. But then there's the rationality of a long-term structural investor who looks right past that initial shock to understand the second and third order effects. What we witnessed was the first kind of rationality completely overwhelming the second. The reason the market's first conclusion is so wrong comes down to this really important economic principle, the Jevons paradox. It's a bit counterintuitive, but it's an idea that's been proven time and time again. When a technology makes a resource dramatically more efficient and cheaper to use, our total consumption of that resource doesn't go down. It goes up, often dramatically, because the barrier to using it collapses and we suddenly find a million new ways to use it. Let's walk through exactly how this applies here. Step 1.
we get a huge efficiency gain. Memory becomes 6 times more efficient thanks to Google's algorithm. Step 2. Costs collapse. The single biggest cost bottleneck for running complex AI, which is memory, just got way cheaper. Step 3. Adoption explodes. All of a sudden, enterprises that couldn't afford to run long context AI or these complex multi-agent systems, now they can. All these new applications become economically viable. And that leads to step 4. Total demand increases. The sheer proliferation of all these new AI applications completely outpaces that 6x efficiency gain, leading to a net increase in the total amount of memory the world needs. We've seen this movie before. This isn't a disruption to the memory industry, it's an accelerator. But right now, the panic is flushing out all the speculative money, and that's often a very healthy, if painful, process.
All right, let's move to the fifth threat, regulation. A draft of a new bill called the Clarity Act was leaked in Washington, and it sent another wave of panic through the crypto markets, hitting stablecoins especially hard. But just like the memory story, the market's first reaction completely failed to understand the critical details of what was actually being proposed.
Here's the thing you have to understand. There are 2 fundamentally different ways you can earn a yield with a stablecoin like USDC. The first way is lending yield. You deposit your USDC on an exchange, it gets lent out to traders who want leverage, and you earn a yield based on that market demand. The Clarity Act does not target this at all. The second type is reserve interest. The issuer, Circle, takes the real dollars backing all the USDC and invests them in safe US Treasury bills, and they earn interest. The bill's target is any mechanism that passes that specific interest through to the end user. It wants to stop stablecoins from acting like high-yield savings accounts.
So let's look at who this actually impacts. Circle, the company that issues USDC, earns billions by holding those reserves and collecting the interest from treasuries. But, and this is key, it has never passed that interest directly to ordinary USDC holders. So its core business model is completely untouched by this bill. Now, Coinbase, on the other hand, is directly in the crosshairs. They have a deal where they get a cut of that reserve interest and they use that money to fund their very popular USDC rewards program. That program is a clear-cut example of passing reserve interest to users, and it is precisely what this bill is designed to eliminate. The market sold everything, but the real impact is far more surgical.
So when you put all of these different pieces together, what are the new rules of the game? A much clearer framework starts to emerge from the chaos. First, a new world order is being born in both software and hardware. The rise of AI agents is fracturing old software models and, at the same time, igniting this huge CPU renaissance. The era of comfortable duopolies is over. The warring states era has begun, and competition is going to be fierce. Second, not all disruptions are what they seem on the surface. The market's knee-jerk reaction often creates incredible long-term opportunity. We just saw it with the memory panic. A deeper understanding of second-order effects, like the Jevons paradox, is what separates a real investor from a speculator just caught in a stampede. Third, in a world of hype, the real winners are often the quiet ones. This brings us to the news about OpenAI killing Sora. Shelving a viral video generator to focus on boring enterprise tools isn't a retreat, it's a sign of maturity. The war is shifting from who has the coolest demo to who can generate real, predictable cash flow. And you know what? This principle applies everywhere. For these moonshots like Musk's Terrify, the most certain returns aren't in the audacious goal itself, but in the picks and shovels companies that provide the indispensable equipment. They are the quiet winners. And finally, it's about separating the core vision from all the noise. The stablecoin bill isn't an attack on the idea of digital dollars for payments. It's an attack on the digital savings account model. The core infrastructure thesis remains completely intact, even if one specific feature gets delayed by lobbying. These are the new rules. You have to understand the paradigm shifts. You have to look past the first-level panic, and you have to focus on the real underlying value, whether that's in infrastructure, in cash flow, or in a core use case that can survive all the regulatory noise.
Markets reward the people who do the work before the crowd shows up. You just did the work. See you in the next one.